stock market is pretty terrible. The economic data is starting to roll over. The market is still pricing in a Fed funds rate of about 2.5 to 3% in early 2023. There is no way that this happens without something breaking first. I'm Michael Smith, and welcome to The Lowdown. Joining for this edition of Lowdown to my right hand, Chris Roberts. Chris, welcome to the show.
Good to be back, Mike.
Well, let's talk about the carnage, and believe me, it is a lot out there. You've got the NASDAQ is down about 30% now. You've got the Russell 2000 about 29%, the S&P around 18%, give or take. Pre-pandemic stocks or pandemic stocks around 70%, and crypto, well, that's all over the place. So a lot of bloodbath out there, and that kind of gets me to where I want to talk with you is about what is the first thing and the first, I guess, just, place to go to when you got markets acting like this and you got everybody out there screaming. What is the first thing you come to? And that's what?
Well, I can tell you this, Mike, it's not about markets. Right now, instances like what we're seeing in 2022 really emphasize the importance of financial planning, really, at a time like this, right? The important thing investors need to be doing right now is stress testing their portfolios, stress testing their financial plans, and it gives you confidence that you can make it through any kind of a storm, right? So we typically refer to these at our firm as Monte Carlo analyses, right? We want to back test your situation. We want to back test your specific plan through 1,000 different potential scenarios to arrive at, what's your likelihood of success? We want to look at all these different scenarios, and if you have a high likelihood of success, so to speak, well, that means that you have accounted for incidences like what we're seeing in 2022. And I think it's also important that investors make long-term financial planning-driven investment decisions as well. And what I mean by that is, we shouldn't be making short-term emotional decisions based on what we see on the headline indexes, what we see on CNBC every single day. What an investor should be doing is be looking at their plan and look at what their plan requires them to take in terms of risk and return in the long run, right? Your portfolio decisions shouldn't be guided by what's happened over the last 3 months. They should be guided by the long-term risk and return needs of your financial plan. So to speak. So I think that what you need to do is you need to make, long-term financial planning driven investment decisions, like I said before. And what that allows you to do is really just de-stress yourself in times like these, right? A lot of people often say, it's like, I got to cash out now. I want to cash out in a correction. Again, that's a short-term emotional decision. It's much better to make an objective, data-driven portfolio decision focused on your long-term time horizon. And if you do cash out, I think the worst thing that can happen is you do so, and then you sit on the sideline waiting for a perfect time to buy that may not ever arrive. And that's why it's important that you make those planning-driven investment decisions. That analysis will help you determine how you should be allocated for the long term, not necessarily the short term. And then, of course, in times of stress as well, I think individuals need to avoid, financial planning pitfalls as well.
Well, yeah. So, bottom line is let me circle things back. What I'm hearing is definitely, you got times of stress right now. Everyone's running around their, head cut off, and the best thing we can do, and what we have for all of our clients, and we've been encouraging for, our listeners for years, is to get a financial planning. If you have a situation, what we're seeing right now, you come back, you make planning decisions based on your overall goals, everything that you have in the plan, and some of the pitfalls that people have is, especially think about it in the last couple of weeks, we're hearing people stressed because of the market and the direction it's gone. They're talking about, I can't make this certain bill, I can't make, mortgage payments or whatever. Well, they're probably taking too much risk. If you had a financial plan already in place, you would know how much risk was too much risk. You would already know where to be taking things off the table, stress testing, back to what you said. Yep. Stress testing your portfolio when using Monte Carlo can show us the probability of success that you meet your goals, and it can also show us how much risk can put you in a bad position. And so the goal and what we've been talking about, and we said in our last time, Chris, when we were on here, is this is not the time to be taking more risk than your plan desires. Yeah. So peeling that back. And so if people are feeling pain now, it's probably telling me they don't have a financial plan that's guiding those decisions. So, and you could probably speak to some of the other pitfalls, but there's many of the pitfalls that can happen.
Exactly, Mike. And when we're talking about, financial planning tips in this environment, if you will, right? We've talked about maintaining a long-term time horizon, using your plan and the construction of that plan to make objective long-term risk decisions for yourself. Everyone's situation is a little bit different, right? When we're talking about stress testing people's plans, what we're talking about is stress testing your specific situation relative to your portfolio and then modifying that, relative to the needs, your long-term needs, right? We're not using a plan to make a short-term decision. We're using it to make a long-term decision, so to speak. But in times of stress, like you said, it's still a very, hectic and stressful time. And there's certain things that we can avoid. Things like making a big withdrawal in a correction, right? So if you have an unexpected expense, right? You say, hey, you know what? Actually, I think I want to go out and buy a BMW. Well, that's going to require you to potentially liquidate some assets and liquidate those assets in a correction. Doing so can really compound the negative effect of doing so on your financial plan. That's why you want to avoid large, unexpected withdrawals in times of in times of trouble, so to speak. And then you should also try to piecemeal your portfolio withdrawals, right? We typically talk about, drawing from your portfolio, if you're in the retirement phase at least, on a monthly or quarterly basis. That helps you mitigate sequence of returns risk or bad timing risk, right? We always say, we always use this old adage of, we always want to try to avoid selling a stock at a bad time. Now, inherently, you can't always do that, but by piecemealing your distributions, that can certainly help you avoid that risk.
And I'll add, Chris, one of the reasons why when we go through expenses, we've asked a lot of our clients, when we're looking at your plan and building your plan out, is separating your non-discretionary and your discretionary expenses. So for instance, you talk about a time in a year where the market is down. Well, when you're taking withdrawals and those type of things, just think back when, if you're retired, if you were working, what did you get, when you're working? Some years you got bonuses, right? So when you had a bonus, you had maybe a nicer vacation, maybe you had a nicer purchase, you upgraded the kitchen, whatever it may be. But in years you didn't have a bonus, you had to sock it in. Well, it's the same thing. When the market gives us a good year, we tell our clients, you know what, you could probably increase your, discretionary expenses. But in times like this is where you got to buckle up and say, what is it the minimum I need in terms of withdrawals? And stick to that type of plan is going to help you be successful.
Right. And if you think back, Mike, when we were doing, a different form of these kind of webcasts back in the peak of the pandemic, right, we talked a lot about guardrails, right?
Yes.
And putting up guardrails for yourself in times of trouble, so to speak. And that's exactly what you're talking about. But then also, I think another thing we got to keep in mind is that, when we're talking about never selling a stock at a bad time, right, you want to draw from the assets that are working right now, right? You don't want to liquidate portfolio positions at a steep loss right now, or that are performing the worst. Unnecessary losses, exactly. But that really goes back to the need for diversification. And that's not so much as having a diversified portfolio of stocks and bonds. Let's say you have a traditional 60-40. You want to have diversification within the 60 and within the 40 as well. You don't want to just have 100% of your exposure in equity markets in the S&P 500. You also don't want to have 100% of your bond exposure in the aggregate bond index. You want to have little pieces within those different components to drive a more, a diversified portfolio, but that'll also give you things you can draw on in times of trouble, right? So uncorrelated asset classes, we talked about it last time I was on the show, value stocks, for example, right? Those have been significantly more in favor than the growth positions this year. And we, and we've talked about taking an overweight position in value stocks as well. So that's the kind of thing we're talking about, right? It's diversification within your portfolio, within your risk exposure, so to speak, which was what we were talking about before. That can be equally as important as having, just generally speaking, a diversified portfolio amongst broad asset classes, getting granularly diversified as well.
So basically, having a financial plan, that's going to be the first, line of defense, basically, that you need in this type of market. So that's just a start. And hopefully, we would encourage those that don't have it to go ahead and get that. But that's the best way you can at least move forward in combating this type of market.
Absolutely, Mike.
So Chris, let's put this 2022 correction in perspective. This is the second worst start for the S&P 500 in history. And so that's a lot to be said there. I mean, this has happened. And by the way, we've said this before. Once the liquidity of the markets, the Fed starts to change direction, central banks change the direction of liquidity, we would see an opposite effect. And that's exactly what we're seeing. And we'll talk more on that in a minute. But just, how much more can we go through? And what is this market? What do we, everyone's asking the question, how much more carnage, how much more pain? So give us kind of some idea of some of the things you and I have been discussing and where markets have been historically.
Well, I think it's really important that we put this correction into context, right? The best thing we can rely on is history. And while I think the playbook has certainly changed, especially over the last couple of years since the pandemic, we'll pull a chart up here, but the average intra-year drawdown in the last 42 years for the S&P 500 has been about 14%. So currently, as we're recording this, the S&P is down about 19%. And then, despite those drawdowns, in the last 42 years, the annual return of the S&P 500 was still positive in 32 of those 42 years. So I think what this highlights is, and it goes back to keeping that long-term time horizon that we talked about in the last segment, is staying invested in these conditions. You don't want to make a short-term emotional decision at the bottom, so to speak. We might have another leg down to give from here. Again, there's too many balls in the air to truly stake our stake in the sand, so to speak, and say this is what's going to happen. That's not what we're here for. But what we do want to do is look at this in context, so to speak, and realize that, hey, this is out of the normal, and then we could definitely have a reversion to the mean here shortly.
So basically, bottom line is we could have some more pain to go, and we'll talk about kind of the Fed here in a moment. But at the end of the day, the growth component of your portfolio, that longer term piece of your portfolio, as you've seen through time and history, the markets have corrected, the markets have come back, and so that's where I think a lot of people right now, good heads need to prevail. Is don't take action on that long part, stick it through, and hopefully the plan has guided you to keep the risk where you need to have it.
Absolutely, Mike. So Mike, we were just talking about, intra-year drawdowns, so to speak. And I think it's really important that we also put into context, how stocks perform around recessions, right? The number one thing on everyone's mind right now is, are we headed for an inflation, interest rate, Fed-driven, demand-driven, and, recession? Whatever the driver of the recession is, it could very well happen, and it could happen pretty soon. So one of the things I wanted to focus on, and we'll throw this chart up as well, is, how do markets perform before, during, and in the months and years leading or coming after a recession? So to speak, right? And to a lot of people's surprise, when you're in the depth of the recession itself, when the lagging economic indicators are sounding the alarm bells saying, hey, we're in a recession, such as, 2 consecutive quarters of GDP contraction or what have you, typically markets are pretty flat, and that's because markets are forward-looking, right? We're not pricing in what happened yesterday. We're pricing in what happened tomorrow, right? So the decline comes before the recession.
Correct.
Markets remain relatively flat, at least from a historical perspective, during the recession, and then they begin to recover long before the recession is over, right? And so that's why you see positive returns before the lagging indicators, such as GDP growth, officially tell you that you have exited this shock, you have exited this downturn, so to speak. So I think that as we've seen the sell-off this year, we've seen some of the preliminary recession alarm bells, the forward-leading indicators, such as revising earnings downward for the next 12 months, the next 24 months. And then we also got the GDP print a couple weeks ago as well, which was contractionary, but for some different reasons other than just the economy slowing down.
What about those with cash? I mean, we still, for instance, you got those that are retired. I mean, obviously, the dollar cost averaging has somewhat ceased, but you can increase risk, at a time where there's opportunity. But also for those that are still saving, those that are putting money into their 401ks and into their investments every month. I mean, you were talking earlier offline with me about the price to earnings ratio, but maybe you could speak a little bit to that. Since this correction, where are valuations, and could this be an attractive point of entry for those that are still trying to save and actually risk up?
Right, Mike, and I'm glad you brought that up because we've got 2 great charts in front of us here. Some of this that we've been exchanging back and forth on this week and last week, and we're really looking at just simple price to earnings ratios, right? So the value of a stock, or the price of a stock divided by its earnings per share, right? That's one of the most telltale valuation metrics we have available. Over the last couple of years, those valuation metrics have been sounding the alarm bell, so to speak, way overvalued. But the low interest rate environment, the high liquidity environment was really supporting those valuations. With the sell-off we've seen this year, we've really seen PE ratios or price to earnings ratios come down to the 7-year average, which is about 18 times earnings. When we're talking about putting money to work, that is a sign that it might be time to begin putting money to work. And then moreover, if we look at the maximum drawdown in PE ratios on an intra-year basis, right? So each year, the drawdown in the PE ratio, we are now at the point what we saw at the end of 2018 and what we saw during the COVID flash crash in 2020, right? Okay. Those rapid drawdowns. Yeah. In the following 12 months the 12 months that followed both of those events, markets appreciated pretty steadily. So is this a sign that a bottom is coming? Well, we'd certainly hope so. It does definitely not a telltale sign. One of the biggest things that we have to keep our eyes on is these are all forward earnings, forward price to earnings ratios, right? So this is the price of a stock based on its forward 12-month earnings, looking out into the future. And I think it's important that people realize that in the early stages of a recession, or if the recession alarm bells are being sounded, so to speak, what's going to happen is those earnings estimates are going to be revised downward, which could force PE multiples up without necessarily a lot of price appreciation. So there's a yin and a yang here, but we're definitely seeing some fundamental metrics say, hey, might be a good buying opportunity.
Well, we're not calling for the bottom, but one thing Warren Buffett always said is invest when others are fearful.
Yeah.
And I can tell you this, there's not anybody who'll probably disagree. Watch any amount of news, Twitter, whatever it may be, everyone is fearful.
Yeah, and look, I mean, for the last couple of years, it's been painful for us as market analysts, as advisors, to look at valuations in markets and be like, gosh, on a historic basis, we're really running high right now. Things are really boiling over, so to speak. And I think that's probably been a driver behind this sell-off, right?
We've known that because the Feds had their foot on the gas, providing liquidity. But when the foot came off, which is exactly what we're going through now, that's why we've changed our stance and where we are. Yeah,
but at the same time, it does brings fundamentals back into the picture, which has an eye, right? What a company's intrinsically worth. Using ratios that have helped investors make decisions for many, many years, they finally are ringing true again, and that feels good in a way. That tells me that, hey, there might be somewhat of a return to normalcy here, which is helpful in the long run.
So, Chris, let's kind of talk a little bit about inflation. We know CPI came out today, and I'm going to let you speak a little bit to the numbers. But, I just want to talk about, kind of the Federal Reserve. I mean, if you look at, many are trying to figure out what decisions they're going to make. Well, let me ask you a question real quick. Of the 11 FOMC members, how many of them do you think have had an actual job with experience?
Well, not enough, Mike. I can tell you that much.
Okay, one. And then if you take that's at McKinsey, okay? And then if you go back to, there's two that were basically in academia, but the rest, no job experience, no practical world experience. And so this is basically the people that are making decisions. And right now, you've got a lot of demand destruction out there. You got a lot of these things that are happening. Everyone's kind of decided, can the Fed continue to move forward with the number of rate increases, right? And so I think that kind of dovetails a little bit into what happened with CPI this week. What do those numbers tell us, and kind of what do we feel that might be leading the Fed in terms of direction?
Right, Mike, because as Powell made clear in his announcement recently, and really what we've seen overall is that the Fed's main focus now is inflation, right? So let's just break down the numbers, right? So in the 12 months leading up to March of 2022, so that was 2 months ago's inflation numbers, the CPI was up 8.5%. In the 12 months leading up to April, which was this most recent report, the consumer price index increased 8.3%. So is that an early sign that inflation is peaking? Potentially. We got a similar signal from the producer's price index today where, the rate over the last 12 months has cooled off a little bit, but the problem is that economists were expecting more of a cool off, right? And so that's why we've seen that precipitous sell-off since that announcement earlier this week. And so we're kind of in this point where, surprises always create volatility, right? Everything is, we talked earlier in this episode about how markets are forward-looking, and, surprises create volatility like what we saw in the report on May 11th. And then, of course, let's look at a couple of the underlying components as well. So I think that's pretty important, right? So the CPI gains, they came even though, the price of energy declined 2.7% in the month of April, and actually gasoline dropped 6.1% in the month of April. But then that was offset by an increase in food costs. And then, of course, on a rolling 12-month basis, energy is still up, 30%. Food rose 9.4% on a rolling 12-month basis. Even with those gasoline drops in April, this past week, we have seen the highest prices at the pump, on a non-inflation adjusted basis. So to bring that all full circle back to the Fed, right? What we talked about last time I was on the show was, where could the Fed pivot, right? Because that's what we were talking about. We were talking about how, they could potentially pivot and create, some bullish momentum for equity markets, but continuous inflation surprises, right? One that where inflation is not cooling as fast as they want it to will prevent them from being able to pivot, so to speak.
Well, and I was going to say, you know, on that point, if you've seen goods and commodities inflation has basically somewhat slowed, right? So we've seen, you can name the commodity, it's probably gone down. But the problem is the Fed didn't act ahead of time. When we saw commodity prices peaking a year ago, that's when they should have stepped in and actually getting aggressive. Remember, they said it was transitory, but now what it's done is creeped into services, and they're behind the curve. And so I think likely what we're going to see is they're probably going to stick to this tune for a little while longer, which basically means they're going to allow a lot more pain to come through before I think anything drastic happens. If they continue with 50 basis point increases at each meeting, I don't think we'll get into September without something breaking, and I don't think we're going to get that far, because at some point, is it inflation that we're targeting, or are we going to be looking at the wreckage to the economy, the stock market, and everything else? Which one becomes more, I guess, problematic?
They are juggling a lot of balls right now.
Oh, yeah.
You know, they're like a clown on a unicycle, so to speak.
Well, that's a tough one.
Yeah, definitely is. But, you know, to your point on energy, right? Well, you know, energy or commodities or really fossil fuels are the driver of a lot of the inflation we've seen, right? Because your goods have to get from point A to point B, and they get transported by vehicles, ships, what have you, burning fossil fuels, right? So if we see fossil fuels potentially begin to roll over versus where they've been recently, that could put some downward pressure on inflation, which would definitely be a good sign for the Fed, and it would definitely be, you know, a good sign for portfolios as well, hopefully, in that regard. And you were talking about all the different, you know, members of the Fed. You know, we just heard today, right before we started to record this episode, you know, Powell was reelected by the Senate for another 4-year term to lead the Fed, so to speak. So we know they've got confidence in him. I don't know if investors or ourselves have confidence in him, but hey, you know, at least Congress does.
Well, and that gets me to my close. I mean, if you think a little bit, you know, Jerome Powell, his hero's been Paul Volcker. And, you know, I had many clients this week. We talked about, you know, the mortgages at 13%. A lot of the baby boomers, you guys remember when interest rates were pretty high. A lot of millennials, Chris, you don't remember an interest rate being more than 3%. So I've seen both sides of it. But bottom line being is that Volcker is a whole different animal, had a different economy. Jerome Powell is no Volcker. But from a little bit of an ego standpoint, you know, does he really want to see the global economy, the U.S. economy, go into an all-out recession? I don't think so. You don't want to go down in history of that being the case. And now that you got another 4 years, well, you know what? The last thing you want to do, that's 4 years. You can actually become a hero, get the U.S. economy where it needs to be. It's not going to be easy, like you said, juggling a lot of balls. But I don't think they're going to move full pace forward with this long term and crash the economy.
Absolutely, Mike. You know, it's no one wants that on their Wikipedia page, right? So, you know, I think that just to kind of come full circle here, I mean, I think that there's a lot of variables at play right now, and it really comes back to, you know, making sure, you know, you're prepared for these events. Goes back to financial planning, goes back to stress testing, Monte Carlo analyses, making sure that you're making objective portfolio decisions based on your needs, you know, and just kind of, you know, talk about our first segment again. I think that's what's most important in times like these, right? If you knew ahead of at a time when this happened that you were prepared, you should be sleeping okay right now.
Absolutely.
And then if you're not prepared, well, you know, we can help you get prepared, so to speak. And I think that's a great way to close today's show, Mike. So I'll let you take it from there.
Well, Chris, great advice for tough times, and so hopefully those listening will act upon that. Chris, thanks for joining.
Absolutely.
Well, thank you for joining. If you have any questions or comments, as always, make sure you hit my email, get to the website, and thank you for listening to The Lowdown.